All right. Hey, welcome everybody. As people are getting on here, we'll give you a little bit of time. Thanks for taking time out of your day to join all of us. We've all put on collared shirts because at least Adam and I haven't had those since March. So we're really happy to have you guys on. And we've got a whole bunch more people that are still coming on. So again, if you're on the Playing for Keeps webinar, you're in the right place. We've got an all-star panel for you. This is the third year that we're actually doing this. And the last couple of years were done in person. And so we've had to adapt and overcome like everybody else in this weird year of 2020. So just a reminder for everybody, we're going to have plenty of interaction and dialogue that we do want to have. Like we've had in our live events, but basically what we want to do is use the Q&A button if you've got questions, and if you want to chat and harass us, you can hit us up with that as well. We're pretty adept at that as well. So what I'm going to do is I'm going to do a quick little intro for each one, but I want you to be able to hear and see each one of these panelists, and the way that you're going to be able to do that is if they're talking. So I'll let them do a little bit more intro. Again, everybody is on mute. If you do have questions, we do encourage that because we don't want this to just be 90 minutes of talking. So at least us talking at you. So here we go. Here are the panelists that you guys are going to be able to see and hear from. And we're going to go kind of in order of not A's first, but it really is about, you know, if you're thinking about selling or transitioning internally, externally, et cetera, kind of what are the steps and the expertise levels that you're going to need throughout that entire process. So we're going to start with Adam Petricoff. He's managing partner of VR Mergers and Acquisitions. Then we're going to move to the tax side with Adam Boatsman, founding partner of BGW CPA, who I'm a part of as well. And Brandy Milazzo, founding and managing partner of Ascension Law. And then Doug Smith, the SVP and Charlotte Market Executive for First Bank. So again, welcome to you all. And why don't we have each one of you guys give a little bit more background, and then we'll move into Adam's side. So Adam Petricoff, if you would, give us a little bit more, and so people can talk and hear you and see you.
Great. Adam Petricoff, managing partner of VR Mergers and Acquisitions and Business Brokerage. Been serving the area for over 20 years. And we work with small businesses to medium-sized businesses to help business owners exit when the time is right.
Great. Adam Boatsman.
Hey, thanks, Gary. Adam Boatsman, managing partner of BGW CPA. Greetings from the Starship Enterprise, everybody. I promised the panelists that I would not embarrass them by wearing my Star Trek uniform that, yes, Brandy, I do actually have and haul out during Halloween time. I'll send you a picture. Anyway, very similar to Adam, you know, I think all of us really represent small to mid-sized businesses, which in our world could be anybody from a startup up to, you know, $500 million. But really, you know, the primary focus of BGW is to focus on helping the entrepreneur take their business from cradle to grave, which grave sounds very negative. It's really to have a successful exit, whatever that looks like, which is really the purpose of this panel debate. So thanks, Gary.
All right. Hey, Brandy, how about you?
Good morning, everyone. Brandy Milazzo, founding partner, managing partner of Ascension Law. And Adam, you can keep your picture. I will take your word for it. I will be in the Grand Canyon, so no mail can get to me anyway at the bottom. So we are a full service law firm, but my practice focuses on corporate transactional work, primarily mergers and acquisitions. And so most of us come from big firm, and we love working with business owners to help them keep legal obstacles from getting in the way of business success, particularly when you are selling your business or exiting your business. And so that is what we like to do. We can help businesses of all sizes, and we're here to help you walk through that process, which can be a little overwhelming sometimes, but very exciting for us.
Awesome. Hey, how about you, Doug?
Hey, good morning, everybody. Doug Smith. I'm going to make a quick disclaimer that this background you see behind me, unlike the Starship Enterprise and the Grand Canyon and Adam's cool company background logo, that actually is the background. I didn't choose to have a loading dock background behind me. That really is a truck. I'm just not intelligent enough to know how to do it. Yeah, First Bank, for all of those who are not familiar with us, we are the largest North Carolina owned and headquartered community bank, about $7 billion in assets. Bankers like to flex their muscles with asset size. So we are a full service bank. Worked with this great group and this great panel on a lot of different opportunities and transactions. So really excited to be with them again and with you all. So thank you for the time.
All right. Well, first up on deck is Adam Petricoff. So Adam, I'm going to let you take it away.
Well, thank you, Gary, and thanks to the panelists. Really excited to, for the third year, have this topic. We put this together because we really thought there was a need for business owners to hear educational advice for them as they think about whether it's 1 year or 10 years from now, things they need to be working on. So we're all going to be touching on various things that you as a business owner need to be addressing in your business and eventual exit. So let me start off with some good news. You know, it's a pandemic, so let's think positively. And what I want to tell everybody is, yes, deals, transactions are getting done right now. We closed a deal on Monday of this week. We have a couple more in the queue. I know Brandy's working on deals. I know Doug and Adam are advising their clients. Deals are getting done. The next question is, well, are valuations taking a hit? And that depends. If you're in the restaurant or hospitality industry, yes. If you've got a good business that's doing relatively well, there's not so much of a hit right now on valuation. The banks and valuation companies want to see that you're trending back at or above pre-March. And if that's the case, I can assure you there are not valuation hits going on in the marketplace. But deals have changed. There is more due diligence than ever. So the folks on this panel are more important than ever. There's more digging into your financials. There's more digging into accounting items. There's more legal issues, and the banks have to be fully supportive on what they're going to be funding. So the other part of good news that I want to share is there are plenty of buyers out there, whether they be individual, whether they be strategic, or whether it be private equity. There is still a ton of money out there chasing deals. So again, more due diligence is being done and more scrutiny is going on in the financials because they are now looking at deals on a month, year-over-year basis, and in some cases, week by week. So what does that mean? That means that if you're getting ready to go to the market, and this is always the case, but more so now and even over the next couple of years, because they're going to be looking back at 2020 and asking questions, you really need to have your financial house in order. It needs to make sense. They need to, records need to match each other, meaning P&Ls need to match tax returns. And your expenses need to be explainable and documented. If they don't exist, if there's documentation that's missing, we can't necessarily count it, but more so, it's going to raise a lot of questions for a buyer. What I challenge owners to do is to really think like a buyer. Look at your own financials with your CPA or your bookkeeper and really analyze them before you expose them to someone externally. You're going to see what they're going to see, and maybe you can work on it or correct it or have an explanation ready. The other thing we recommend people to do is really clean up your personal expenses before you're getting ready to go. And I know that's a challenge because you want to put the expenses in because it lowers your taxes, but really work with your tax advisor to come up with a strategy to make sure that your books are as clean as possible. I can tell you in this market, and again, as you go out over the next 2 or 3 years, 2020 is going to become part of your financial records. banks and buyers are going to be looking closer than ever of what's going on. So take notes of when you allocated your PPP or EIDL loan. Take notes on how you handled things in 2020. Because if you're looking in 22 or 23, you may not remember. So please take notes now of what you are doing in your business. So the next thing people ask us is, what can we do to increase the value of the company? And everything I'm going to tell you has absolutely nothing to do with COVID, because these principles are just true, pandemic or not. And first of all, buyers want to buy a business that is growing. That sounds obvious, but they want to see year over year growth. Now, yes, we are challenged right now. There are people that if they get back to even, that is growing from where they were just a few months ago. And buyers and banks understand that. They just want to see that the trends are going back up. But obviously, if you have been down multiple years in a row, say 19 and 20, you're probably going to have to show a positive year in 21 before someone's A, going to finance it, and B, going to be serious about a business. The other things we tell people is really focus on what we call the independence issues. So is there a particular employee that controls so many of the relationships with your key clients? Is there a key vendor? Or in this case, as we've learned over the last 18 months, are all of your products coming from China? Or are they coming from a specific factory in China? And that's clearly created headaches over the last 18 months. So work on independence issues, work on not being too reliant on a key employee or a key vendor, which then leads into the next topic, which is concentration issues. Take an analysis of your clients and look at what percentage your top 3 clients are or your top 10 clients are, and do everything you can to shift. And I know that's easier said than done because we all like to catch the big order or the big account. But when you start getting 2 or 3 clients that equate 40, 50, 60% of your business, while it's helping you grow, it actually makes both banks and buyers a little bit uncomfortable with the concentration. So you might have to have a multi-year plan to work out how you can reduce the risk to a buyer and to a bank when you have so much concentrated in so few customers. Another aspect that people look at is your revenue and what type of revenue you have. Of course, we all like recurring revenue, but most people have transactional or ongoing order revenue. Figure out maybe how over the next 3 or 4 years, can you create 10% of your revenue to be recurring? These little things matter. The other thing buyers and banks look at is, do you have the ability to raise your prices? Whether you do so or not is your personal business decision, but the ability to do so is really important. Or are you always in a competitive bid? It's the lowest price and you get the business through the bid process. Finally, one thing that we tell owners, and this is the hardest thing to do, is work on making yourself less relevant every day. You don't want to be the business where someone feels like they're buying you, the owner, instead of your business. So make sure you delegate, make sure you have people around you that have the ability to make decisions. I always like to ask owners when we sit down and talk to them, do you have the ability to go away for 2, 3, or 4 weeks and the business exists? If you can go away for 3 or 4 weeks and the business continue to hum along, you've done a good job diversifying the responsibility to your team. If you can't, and maybe 3 weeks is excessive, but how about 2 weeks? Figure out ways to try to delegate so a buyer, when they look at your business, realize that they're actually buying an operating, working company that has management throughout the system. And again, the best way to increase the value of your business is really work with the representatives and the industries on this webinar. You need to be sitting down with your financial advisor and your bank and your CPA and your attorney. You want to know not necessarily how much your business is going to sell for, but you want to know how much you're going to leave after tax with. And so Adam and his team and other qualified CPAs, you need to do that exercise. It's really important to not just know what the market value is, but what you're going to leave the transaction with from a tax liability standpoint. Again, I just want to highlight, these are ways to increase your value. If your books and records and financials and P&Ls are not clean, buyers are walking away. It's just that simple. So the other thing that we tell owners in this market is you need to be focusing on your business. The advisors, the professionals on this webinar, we're here to help you, guide you. Just like we don't know how to run your business, we bring the expertise of running a process and running a successful exit for you, so you're going to get maximum value on your way out. Making sure you're not going to get sued in 2 years, making sure that you're getting the best financial outcome for you and your family from a tax perspective. So make sure you talk about any issues with any of your partners, your spouse, any of your family members. Get these issues resolved before you go to market. Get anything that you think would come up resolved before you're going to go to market. Again, put yourself in the buyer's shoes, critically look at your own business and attack those items. I assure you, you know your own weaknesses. Due diligence, which I mentioned earlier is taking longer, is going to highlight what your own weaknesses are. So start working on them. They will be found, and you're putting yourself in the best position to have a successful outcome. The last thing I would say is, yes, I talked about how business transactions are going on in this market. And the number one reason why, and I should have mentioned this earlier, is the reason why we're confident that transactions are going to take place now and going forward is they have to. They have to, because 10,000 baby boomers are turning 65 every day. They have to because people continue to get sick and people continue to get divorced and people continue to want to move for family reasons. They have to, most importantly, because most business owners have in excess of half or as much as 90% of their wealth tied up into their business, and they need to monetize that asset so they can fund their retirement. So pandemic or not, people are going to continue to be selling their business. And these are some of the things that we see that can help you be more successful when the time is ready. I'll leave you with one final note before I pass it back to Gary. Buyers of businesses today are really good, whether it's an individual, a strategic, or a private equity. They have teams on their side. They know how to buy a business better than you on your own know how to sell a business. It's a game. You got to know the rules. You got to have the advisors on your team. And it's the number one thing that we see is people try to go it alone, or they don't want to get an attorney involved too early, or they don't know their after-tax consequence, or they don't know what their bank, how their bank's going to work with them as they go to transition. You got to be upfront with your advisors. You got to assemble a team, and you've got to understand what you're getting ready for, because selling a business, you get one chance, and these are permanent decisions. And everybody on this panel wants you to be the most successful you can be, but you got to plan and you got to have a great team around you. And so with that, Gary, I'll hand it back to you.
All right, great. You did a great job, Adam, because you anticipated Joe's question. Joe, good to see you on here. And here's the question he had. What are the best ways to build value for the long term in your business? And I think he did an excellent job there, and he acknowledged that and said, great answer, thank you. So anybody else out there that has any questions specifically for Adam Petricoff, go ahead and hit me up now, or you can save it for the end if you come up with other ideas, but that was a really good recap. So anybody else out there? Not seeing anything. So I think what we're going to do is, again, this is not speak now or forever hold your peace. We will get back to you if you have additional questions. Go ahead and hit us up on the Q&A. Let's see. Let's move on to Adam Boatsman.
All right, thanks, Gary. And you can go ahead and flip to the next slide if you want to.
Great.
in terms of, tax strategy, the mechanics of how you sell the company, nothing's really changed from that from last year, in terms of, all right, so the first thing that you got to do is figure out who am I selling to and whether or not I'm going to be part of the organization going forward or not. So, for example, thanks, Joe. I appreciate that. I hope you would appreciate the Starship Enterprise. The first thing you're trying to figure out is, hey, is this an internal sale or not? Like, am I selling to my team? Am I transitioning to my kids? Is this something that's done internally? Because that, a lot of that's going to dictate the transaction structure and, really the method with which you determine the valuation. Because in that case, it's an internal sell. You've got a lot of flexibility. You've got a lot of time. This is the team you trained, in terms of how you structure things, versus strategic buyer or private equity, where maybe I'm going to be part of the organization, maybe I'm not. But even if I think that I'm going to be part of the organization, look, for the people that can stick around in that transaction and get a second bite at the apple, meaning that, part of the consideration they're getting is ownership in the new combined company. A lot of times, if those people can stick around, that second bite at the apple is oftentimes worth as much or more than the original bite at the apple. The problem is, we all started businesses for a reason, and a lot of times it's because we were pissed off at our boss and thought that guy or gal was a moron. So we're unemployable. And it's just, that's something to think about in terms of, when you're thinking about, am I going to go to work for somebody? I mean, you really need to do a gut check and decide, can I actually work for somebody or not when I'm not in charge or in control of my destiny? Because, being in control, even if you're taking the job of something, is just a lever that you're pulling as part of the negotiations. But again, mechanics are all the same. You're basically, making a fundamental decision, which is the person buying the stock or the membership interest in your company, or are they buying the underlying assets? The tax treatment is radically different for both. And sometimes, I'll start with the S corporation first. I mean, if somebody buys stock, that's great for the seller because it's capital gains treatment for you, just like as if you sold any publicly traded stock. For the buyer, it's terrible, because I have these payments that I'm making that I have no deductions associated with them, because I'm not getting to amortize the goodwill associated with your customer list, which is the tax deduction. I'm not getting to redepreciate the assets that I bought that you'd fully depreciated. So buyers are usually not in favor of this. So it's just part of the consideration. And I think what I've seen a lot of times is, especially, I'm going to harp on Adam saying, get people involved early. When I usually get a call, and the first question I always ask is, what's the form of the transaction? Because that's going to dictate a lot. Oh yeah, they're good. We're going to do a stock sale. I always say the same thing. Okay, it's going to be an asset sale, because at some point, probably pretty late in the game, they're going to slip in that they want to do a 338H10 election, which is effectively buying stock, but treating it from a tax purpose as an asset sale. So just, in my entire time of advising companies, which I've been on my own since 2006, I have not seen very many stock sales. And usually, if I have seen a stock sale, it's extremely specific to the requirement, meaning like the company was financed by a 401k plan and the buyer's going to buy it in their own 401k plan, which is usually smaller transactions where you're using a self-directed 401k plan for the financing purposes. Outside of that, pretty much every stock sale that I've seen turns into an asset sale by the time the thing's said and done. And maybe Brandy can opine more on that when she gets to her part, if you don't mind, Brandy. There you go. Threw that ball over to you. So just, be aware that that's going to have a fundamental difference. And what you're taking home and putting in your pocket. C corporation, same way. You know, if it's an asset based on a C corporation, you know, you're talking about a 30% valuation difference when you put it in your pocket. At the end of the day, due to the nature of the double taxation, meaning the C corporation pays tax on all the assets it sold, and then you turn around and pay tax on the money you put in your pocket when you do your liquidating dividend to get the cash out. So, you know, usually these are just all negotiations to get you to a final answer that is a net that you can live with putting in your pocket. You know, some other thoughts on form. You know, if the buyer's really passionate about, I want to do an asset sale, but you structure the whole thing to defer the gain, which I put in, you know, code section 1202. That's specific to C corporations that are generally, you know, product oriented, that are kind of inventing, you know, something or manufacturing something. They have the ability to exclude the gain if they've held the stock long enough up to a certain threshold, which is pretty big. It's $10 million. But if somebody's passionate about an asset sale, man, that's a big difference for you. So again, the tax, I think most people, you know, generally have a feeling that, yeah, taxes are pretty important, but I mean, literally, you know, it could be, you know, 50% difference, you know, if not more, in terms of the cash that you end up putting in your pocket. All comes down to the tax treatment. So, you know, when it comes to, all right, well, that's great. You know, I already know that stuff, Boatsman. You know, thanks. You said that all last year. Correct. I did. The one real big difference that I've been seeing now, though, in terms of the pandemic, is that, you know, I do agree with Adam. I haven't really done a formal survey within BGW around, well, you know, about how many transactions do we have going on last year, you know, versus this year. And I've definitely seen some clients that we've had close that were in discussions, you know, either before the pandemic or got started right as things set out, that are going through the close process now. All that said, you know, one of the things that I have seen, and this was really specific to a transaction that was underway, whole thing's negotiated, but hasn't closed yet, that was everything's worked out pre-pandemic, but then had delays. And I know that delays never happen. I say that very, very, very sarcastically. And remember, buyer, you know, it's always on the buyer's side. They ask you for the delay, they bend over backwards, but when they want to close and then they jam everything in, they want to close right now. So just, you know, so in this particular case, you know, we're all set up, ready to go. You know, transaction's pretty much done and dusted. Buyer asked to put it on hold because they've got to sort out some things internally. Seller agrees. Pandemic happens. Buyer comes back, and due to the nature of the contract, there was some exclusivity stuff that existed with the seller, that they didn't have a lot of other options other than just to pull the whole thing back in terms of who the buyer was going to be. But the buyer fundamentally renegotiated the payment terms such that the price was the same, but instead of it being about a 90% cash deal, it became a 50% cash deal. And the other 50% was related to an earnout. And, you know, I know that, you know, deals are happening at the same time. I don't think we have a whole lot of data yet about what the structures are looking like, but my gut would tell me that, you know, probably earnouts are going to be more common than not, you know, for a period of time going forward. If you're trying to still get a pre-pandemic valuation, but you have flat data to support it, or people still in this unknown, you know, the way that you always close that air ball is associated with, perfect, I'll give you exactly what you want if the business performs to that level. So that, you know, that always represented financial risk, obviously, to the seller, in terms of, you know, Adam doing his job would probably say, well, you know, be happy with what you got cash, because that may be all you're ever going to get. The difference now, though, in terms of where it comes to negotiation, though, is that I think at some point, I don't remember if I set the year, but on some of the webinars that Gary and I do about the Paycheck Protection Program, I did bet somebody that I would shave my head if tax rates did not go up in the next 3 years. And that bet is still active. I'm throwing it out there. So I just find, we have to pay for all this somehow. So the likelihood that tax rates aren't going to change is just crazy. I mean, if I don't think anybody could just say absolutely the tax rates that Trump passed that were temporary in nature are going to remain in effect forever with all this going off. Chances are, at a minimum, they're just going to let the individual rates, which represents 3 to 5% rate difference for some people, just expire quietly without renewal. Because that's already part of the law, is that they do expire. They would have to take action to extend them or make them permanent. So I think that's probably the minimum likelihood, with the maximum likelihood that, corporate tax rates go up a little bit. They reverse the tax cuts that Trump put into place and then layer in something different. My point being that, I'm a big proponent of marriage and staying married, but for the clients that we had that got divorced, if you remember, there was this window of time where alimony was deductible and then it was not deductible. So I'm either paying for alimony with pre-tax money, which is great, I'm getting a deduction for it, or I'm paying for it with post-tax money. Well, if you hadn't signed your documents, then it in that window of time rolled over. If you negotiated an alimony settlement, the amount that you had to pay radically changed in that window of time. And the same thing applies for installment agreements, which effectively an earnout is an installment agreement in some form, meaning I'm going to recognize the income that I receive on getting paid over time instead of all at once, and then just carry a note balance and not have tax in the future. Well, geez, if that's 50% of the consideration, and effectively I'm going to have a 5% tax increase probably in the window of time that I'm getting paid, that just really represents less that you're going to put in your pocket. So it's something to be cognizant of as you're contemplating a deferred payout, in terms of, just figuring out, is there another lever that I could pull to hedge against a possible interest rate increase? I don't have a bunch of answers on that because we don't have any live examples yet of anybody that's done that. But some accelerating the payment, increasing the value that you're going to get, just contemplate the fact that in a transaction done today, the likelihood that tax rates are going to go up is extremely high, and the likelihood that you're probably going to have a deferred payout, especially in larger transactions, is high. You just got to be thinking about that right now. So that to me is what I've really seen from the big picture on the tax side. And I would echo, especially everything that Adam said around, if you didn't have your crap together pre-pandemic, this has been a good opportunity to try to get your crap together. So definitely get your crap together. So thanks, Gary.
Yeah, that's good stuff. So here's a question, and Adam, since you've got the floor, you can take it. You'll probably give the most colorful answer anyway, but this is from Joe. What would be the best response to these companies that are calling every couple of weeks indicating an interest in buying your company, especially if you're not looking to sell?
I'll give a deeper answer, but I always my Uncle Gene made a living for a period of time buying cars at the auto auction, fixing them up, and then flipping them. And he had a really funny line once where the guy says, well, will you take X for it? It's like, will you take, $2,000 below the asking price? And Gene's answer was effectively, if you wire me the money right now, sight unseen, having not driven the car, absolutely. So, there's part of me that just, wants to be sarcastic and say, well, make me an offer and I'll give you the keys tomorrow. You don't need to see anything. Perfect. That's awesome. I think the reality is the people that are calling, and Adam, I'd ask you to chime in on this one if you don't mind. They're really brokers looking for listings, I think, is what I've seen, is that they're people that, are either looking for listings because they have buyers, or they're just generally looking for listings to try to get something going. So I have been, at least that's been my experience in the last couple months when I've had clients that have called. Yeah, I'm getting these calls. I finally took one. It's generally an M&A company looking to represent a seller because they either have buyers or they just need more sellers to try to place some money. So it's not actually the buyer that's calling, it's somebody representing somebody who can connect you with buyers.
And I would just add that typically they're telemarketing companies hired by M&A or brokerage companies to call. And my number one response back, because we get calls all the time, and in fact, it's actually a good lead source when they get called by someone else. They call us because they know us. My response is, your potentially largest asset in your life, you are potentially going to work with a telemarketer based on one phone call about selling your business. My response is, go back and talk to your advisors, get names from them, and understand what you're getting into before you respond. Talk to your CPA, talk to your bank, talk to your attorney, talk to your financial advisor, talk to your people who have been through this before. And if you want to proceed that way, then go for it, but talk with your advisors first.
That is excellent. Brandy Milazzo is next.
Good morning. Hard to follow Mr. Boatsman, but we will give it a good run at it. Gary, you can go ahead and move to the next slide, please. So I would just reiterate, first and foremost, the legal and accounting process together can be more than overwhelming, particularly if you've never done it. And a lot of our sellers tend to be first-time folks, so they tend to be embarrassed because they're not lawyers. And I would always say, you don't know what you don't know. You know what you know, and that's your business, and that's what got you here. So lean on your advisors, and don't be embarrassed. We don't know your business. That's what we're learning from you, or if we've done something in the industry before. So, I just really encourage everybody and reiterate what Adam have already said. Know who has your back in the game and outside the game. So it's not just your outside advisors, but you really need to know who you can count on inside your company, who are your go-tos, who can keep things confidential. A really important point, which Adam Petricoff would generally have already taken care of, make sure you have an NDA or confidentiality agreement with anyone with whom you're talking. And then just make sure that your advisors know who within your company they can and cannot be talking to about any possible transaction. And just be honest with your advisors. We don't expect you to know what we know. That's why you hire us and pay us. Secondly, and most importantly, I think Adam Petricoff said this a lot, and then Adam Boatsman reiterated this. You want to clean up your hand that you've picked or been dealt. So in other words, make sure you're cleaning up your company, working with Adam Petricoff, working with your CPA, Adam Boatsman, and making sure everything is as clean as possible. It doesn't have to be perfect. When it comes to attorneys, I would your legal advisor, make sure they know what's not perfect. Give them the full hand before they get started. I always tell our clients, particularly when we're getting ready to load up due diligence into a data room, the business brokers, no offense, Adam, and the investment bankers love to rush through that and throw it all up there and get through that due diligence so they can get on and get to the closing. But we always tell the clients, and so a lot of times, sometimes the clients will load it up themselves. But once it's out there, we're sort of left with what's out there. So it's better if we know what's clean, not clean, how fix it if we can before it goes up into a data room or goes via email as due diligence to the other side. So again, it's real important to be honest and let us try to help you and clean up what we can before you get started on the deal. One of the most important decisions you will make, other than deciding to sell probably the biggest asset that you have and the advisors that you surround yourself with, is what role are you as the owner or the seller going to play? Are you going to lead the strategy, or are you going to let other players lead? And what I mean by that is this process can be very overwhelming and time consuming, and it's almost for several months, however long it takes, like having another business. So you either need to be the point person with your advisors, or you need to be running the business. And whichever one you're not doing, you really need to have a right-hand person that is doing the other. So if you want to be the main contact with the lawyers and the business broker and the CPA and the bank, then you've got to have somebody within the company that keeps their eye on the ball. Because as Adam Boatsman pointed out, financials are coming through, and you still have to you want to keep your numbers up. You don't want to see a drop during the transaction. And it's just overwhelming and quite frankly exhausting. And so you need help. It's going to be people that you can trust within the company. We've seen it both ways. Generally, the seller wants to be our liaison and wants to be in contact with us, and they have a right-hand person. But we just did a transaction, which Adam Boatsman is aware of, and the seller is a widow and was completely out of the business. And so we dealt primarily with the CFO, who was going to remain afterwards. So, and we've seen that with sellers who are in the business, they step out, work with us, and they appoint someone internally to run the business. And then we've seen it where they appoint the CFO or the COO to help us run the process. So that is really important, because you don't want to have to make that change halfway through the process because it's just too much. Again, be prepared for some deal fatigue. A lot of times what happens is Adam Petricoff has gone through a process with the seller, and they come to us and they're ready to close, and they think closing is going to be within a week. And the due diligence and the lawyers and the accountants are sort of just getting warmed up. So we're all energetic and ready to go. And the seller's like, are you kidding me? So it's called deal fatigue, which is again why you want help. You want somebody within your company helping you on one role or the other. Just know that the due diligence is the biggest part of it. And you're going to feel like 4 of us are asking you the same question 4 different ways. It's generally what I tell sellers on the front end. But once you get through that, and if you've included all of us in the sort of front end, we are more easily able to help you. So just hang in there and get tough, and just hang tough, and know it's a process. If you've decided all your strategy on the front end, you picked your people, you picked your advisors externally, you have your person or people inside, that's really going to help you get through that deal fatigue. Again, always keep your head in the game. And again, having this strategy up front, having your advisors outside and internally knowing who you can rely on, and your advisors knowing who they can rely on, that's going to help you as the seller stay very rested as can be in this process, and focused on the important parts. Because again, you're going to go through a bit of a process, and you really haven't had the full negotiations until after due diligence, because you've gone through a process with Adam. Then you're going through due diligence, which is just giving the buyer a lot of information, a lot of different ways. Sometimes it seems like you're doing, again, the same thing 4 times, 4 different people, 4 different ways. And so really the real negotiation on the finer points doesn't get started until closer to the end with the legal documents. And that's when we as your counsel really need you focused on what you want. And so how, again, these are all tips to help you get there, and how you can do this is sort of deciding the strategy on the front end, and working through it with your other, knowing your tax strategy is critical, because almost everything is based on tax strategy. Everybody says my employees are important, but everything comes down to tax strategy and financial issues. So, and again, I cannot reiterate this enough. If there's something that feels like it's not right, or you don't know the answer, make sure you ask your advisors on the front end. The worst thing that can happen is you don't tell them about something that's bothering you, or it's an issue, or you think it's an issue in the business, and we get halfway through the purchase agreement and we find out about an issue, and then we have to go to the other side and bring it up for the first time. That just doesn't tastes good to the other side, and it's what we call, a lot of times it's a change in the letter of intent, and that's what we call retrading. And you usually have to give up quite a bit in order to get that. So again, the more we know, there is no judgment from any of us. I know that everyone on this panel has seen just about everything from a deal perspective. So just tell us everything up front. That's the best way that we can help you. And then just know that you're going in for this, and it's a little, again, I just can't reiterate enough, it's a process. Just allow us to help you. I will tell you the one that we just closed yesterday. Again, Adam Boatsman is the CPA involved, and the seller was a widow of a person who her husband passed away, and we were selling their interest, and she said that was the easiest thing I've done. She said I didn't have to do anything. And that's really, I mean, sellers that own the business are in the business. It's probably not going to be exactly that way, but it should be if you trust us and allow us to help you and bring up the issues. It should not be that difficult at the end of the day. Stick to the plan, determine your strategy, stick to the plan. What Adam Boatsman said about stock versus asset sale, I get asked that question all the time. And of course we see it as soon as we see the purchase agreement or the letter of intent, we want to talk to the seller CPA and say, let's talk with them, let's work with them to make sure it's right. From a legal perspective, it really doesn't matter. I mean, generally sellers want to do an asset sale so they don't get liabilities, and buyers want to do the membership interest or the stock sale so they can sell everything in kind of one fell swoop. It really doesn't matter at the end of the day. And the contract and the purchase agreement, we can negotiate and make the buyer take liabilities even though they're doing an asset deal, and we can take away liabilities and agree that the seller or the buyer doesn't have to take certain liabilities even in a stock deal. So it really is tax driven. And the main reason we're seeing stock or membership interest deals right now are because a lot of the private equity groups or buyers get favorable tax treatment with certain kind of strategic membership interest purchases. So again, if there's a change midstream, just make sure, listen to your advisors and stick with them. And again, know when to hold them and know when to walk away. I will tell you that, close your ears, Adam Petricoff, the business brokers and the investment bankers get really nervous if we go in really hard and start negotiating really hard on a particular point. I will tell you, I have had probably, I think 2 deals total, and 2 really small deals not go through the whole time, my 20 plus years in my career. But I had one of the best results for a long-standing client, still a client. I've helped him through 2 sale transactions, and he's still doing other businesses. He walked away 3 times on a point. And every time we gave him the great counsel and said, we agree with you, but just know that if you walk away, this could be it. They could walk away and not come back. You don't want to use that lightly. So I don't say that lightly. You want to be really careful and really strategic. In this case, the buyer was going to treat a vendor, a longtime vendor of his and a competitor, but a friend of his, really badly after closing. And another time they were going to really hurt the other minority shareholders from a tax perspective. And both times he wasn't going to allow it. And so he walked away from the deal for about 2 days each time, and they came back, and he didn't get exactly what he wanted, but he got a lot. So, but again, don't use that very lightly, but sometimes you have to do that. Hopefully there's not much of that if you've talked to your advisors all along the way and you've been open about the due diligence. So it's an overwhelming process, but if you take these steps, make sure, if you can, have your legal counsel read everything, including the letter of intent. A lot of folks don't like to hold up the letter of intent. They think the lawyers are going to hold up the process. At least let them have one look to make sure there's nothing missed in there. So, but if you stick to this, an overwhelming process can go fairly smoothly. That's all I have. Gary, do you have any questions?
Great job, as always.
Thank you.
Any questions out there for Brandy while she's still got the floor? Again, if you don't, we will have room at the end of this thing to do it.
They just to find out how to get money for transactions from Mr. Smith.
Sorry, you're breaking up on me.
I said, I think they're just interested in getting to the money part and finding out how they can get money for their transactions.
Yeah,
From Mr.
that's exactly right. Well, that's why we saved the money man for last. So, Doug, the floor is yours.
All right. Thanks. As usual, my teammates on this panel have teed me up well, so I appreciate that. And I mean that genuinely, mainly because Brandy made a great point, right, about make a determination about how involved you want to be in this process. It's funny because if I were you all in the audience, I would think, okay, well, Doug, this is all great, and I'm sure you're a great banker, but at the same time, why would I be concerned about how the financing side of this works? That would really be more of the buyer's responsibility. Well, the truth is you're going to be more involved in that process than you might think you would be. And I say that for a variety of reasons. One is candidly just the disclosure of financial information you're going to need to provide, obviously to the buyer, but also to the bank as the buyer is getting engaged and looking at financing. Not only that, but it's probably a good idea for you to know what's going on the other side of that wall as the conversations continue for the buyer and the bank. And then last but not least, you might become part of the bank, to be honest with you, when you think about potential seller financing. So all very relevant parts that make you want to be involved in the financing side, at least to be educated on it. So looking at the slide here, and I'll just touch on these real quick. Fortunately, Adam Boatsman had already made mention of strategic buyouts, and that could be, well, typically is within the industry, right? It's a competitor, it's a family member, it's a supplier perhaps, but it's someone that's already engaged in the industry as opposed to a roll-up, which would be more of a private equity play, a company that's trying to make a portfolio bigger or a company bigger to be advantageous. And so to Adam Boatsman's point, right, that structure matters. Who's buying you matters. So you want to plan right, thinking about who that target is, but it's also going to matter to the bank in how we would approach it candidly. So I wanted to just think a little bit about what exit opportunities would look like, right? So there's the full sale, just you're out. It's a full exit, and you're getting your payday, a very worthy one, and you move on. There's also the partial sale where you could end up looking at selling 75, 90% of the company, certainly a majority of the company, but you're going to stick around 3 to 5 years. There'll probably be, some sort of expectation to then looking down at that fourth bullet point, the seller earnout, where at that 3 to 5 year period, there's going to be some sort of financial hurdle, expectation, benchmark that you're going to try to reach to ultimately get that remaining 10 to 25% paid out. And then I also listed this dividend recap only because candidly, it's not an exit strategy as much as it is a potential teaser for an exit strategy. And what that looks like is, perhaps you put the company out to sale, out on the market. Adam, as good as he is, Adam Petricoff is as good as he is, just y'all were not able to find the right suitor. You step back and you think, okay, well, maybe I take another 5 to 10 year horizon here, but I have put my wealth into this company. I've kept every dollar inside the company. I'm ready for a liquidity event. And so that's something that the bank could help with too, relative to a dividend recap, and do something that, would be some sort of term loan turned into a monetized dividend for you that could give you a feeling of what retirement might be like 3 to 5 years. You start to entrust more of your management team to take over more of the company, and it just gives you a little level setting of what this could look like. So let's move on to what financing options could look like, right? So the best one for you is just full equity buyout. Someone has a bottomless checkbook and they're able to write you that check, and there's no financing to be worried about. And God bless if that can happen. I hope it can for a lot of you. But at the same time, then the next option relative to making the acquisition happen would be senior debt or bank debt. And I'll get into this a little bit more in a moment, but that's an assessment of the cash flow of the company, the collateral, guarantor support that comes along. We take that three-legged stool and assess how much could the bank really provide in the way of financing for the acquisition. If there is a shortfall, and we're not able to provide all of the financing needed when you tie together what the bank could provide plus the equity that the buyer would put into it, well, then there's other options. There's subordinated debt, kind of junior debt, which either banks or investment bankers have plenty of different channels that they could provide. And that mechanism is obviously at a higher rate, it's unsecured, but it helps close the gap. And candidly, maybe it's 3 to 5 year term debt, but the bank can always come back and look at that a year or two later, reassess that high rate, that junior debt, and refinance it through conventional debt. So that's an option as well. And then obviously we talked a little bit about seller financing. Again, that's typically a 10 to 25% portion of what the acquisition price would amount to, and you would have a note directly to the buyer. The banks, preferably would always want to be in first position of that, but there's plenty of ways to work that out with the bank and with the buyer to be able to make sure that it works for all parties. But that's another opportunity as well. Obviously, Adam Petricoff is very well versed on the SBA 7A side. That's a great financing opportunity, and one where the government basically guarantees 75% of the debt. Loans can go up to $5 million. You could have a 10-year term, which is really advantageous as a buyer, and candidly, probably more advantageous than what the bank could offer. Different strategy relative to the underwriting there, but at the same time, a great option for folks. So let's talk about the bank's priorities, right? What kind of conventional priorities when we would look at financing for an acquisition? I mentioned that three-legged stool earlier, and it's cash flow, collateral, and guarantor support. Nothing is more important to a bank than cash flow, nothing. So that's going to be the biggest leg of the stool, if you will. It might rock the stool a little bit, but that's by far the first thing the bank is going to look at. We want to make sure that, and I'm going to make y'all snooze just a little bit here, but for every dollar of debt you would have, there's $1.25 in cash flow to make it work. That's every banker could probably hand down that formula for you pretty easily. The collateral piece, we would look at real estate, accounts receivable, inventory, equipment, and margin it at a certain level. And then ultimately that helps us understand what the collateral piece could look like. And then last is just guarantor support, and what sort of net worth, liquidity position would the owner of the company, the buyer of the company have after the transaction to be able to add value for the bank as kind of a tertiary source of repayment. Those are the three main pieces. There's this fourth mechanism that we look at too, which is leverage, and just making sure that we're not setting the company up for failure at the time of acquisition, right? If it's over leveraged, it doesn't help the company. It certainly doesn't help the bank. We just want to make sure it's a reasonable amount of debt service that is being taken on. So let's move on to how have the priorities shifted relative to COVID? We've talked a little bit and heard a few comments relative to, deals may be taking longer. There might be more scrutiny. And I won't argue that there isn't more scrutiny. But at the same time, there's a few different angles here. There are some banks who have literally decided, we're going to take our ball and take a timeout for a little bit, right? There are definitely those institutions, and they have reasons for that. Their portfolios might be full of certain industries that they just think there's too much COVID sensitivity and we're going to take a break. I'm fortunate enough to not work for one of those banks, but at the same time, there's definitely still more of a need to make sure that cash flow piece works. That there is still, an opportunity to make sure that loan to values maybe would come down, right? Whereas 85% of an acquisition might be financed before, maybe it's more like 75%. But here's the thing, there is so much, and you've heard this message from certainly Adam Petricoff, there is so much liquidity in the market right now. It is unbelievable. And banks are not remote from that. I read in the Wall Street Journal at the end of last week that since January, all banks across the country, so I think there's something like just shy of 5,000 banks in the US now, all of those banks have accumulated $2.4 trillion more in deposits since January. 2.4, that's a T, trillion since January. That's the same amount of deposits that all banks had in 1984. So there is a massive amount of liquidity that's being held by the banks, that's being held by the bank's clients. And as a result, you know, candidly, for the right opportunities, for with diligent underwriting, yes, but at the same time, there's plenty of liquidity for banks to be able to get money back out into the market. And candidly, yield and interest rates will always be important to us, but balance sheet growth is going to be very important to us. And so we would always want to be able to make sure that we're getting money back out on the street, as opposed to being, you know, too stingy with it, or thinking too much about investing in bonds that would make us 10 basis points. So there's plenty of liquidity out there, and I definitely want you all to be able to walk away from that with that realization. Refinancing is driving the market, and we're seeing a lot of folks that are just thinking, hey, look, now is a good time to just kind of cast the net and make sure that I've got the right structure, the right deal. So there's a lot of that activity out there right now too, due to COVID. So, you know, I know Adam Petricoff mentioned earlier, you know, relative to getting with your CPA, right? Getting with your financial advisors and thinking through, who do you want to sell to? What's the value of your company? Come up with a good assessment. So here's the last piece of advice I'll have for you. Any banker who is worth their weight in gold, no pun intended, would definitely be in a position to look at your company now, right? As you're assessing a potential sale, whether that's 5 months from now, 5 years from now, 10 years from now, but should be able to do what's called a debt capacity analysis for you. And all that is taking that three-legged stool that I've probably beaten a dead horse with, but looking at cash flow, collateral, guarantor support, and leverage. Actually, take out the guarantor support. It's more leverage, cash flow, and collateral, and figuring out, you know, kind of taking a weighted average of those three. But if I know that cash flow is X, collateral is Y, and the leverage shouldn't go beyond Z, how much should a bank be able to lend on your company? That's something that, candidly, with the right financials, it is a pro bono service that any banker ought to be able to provide to you. And I'd recommend it just as you go through this process and get with your banker and ask them to be able to do that, because it's a simple process and one that we've been trained to do. And literally, it would be a pro bono service. It is not a valuation. You shouldn't take that as a valuation. It is nothing more than just a debt capacity analysis from the bank's perspective. Gary, that's all that I had from the finance perspective. So happy to take any questions.
Great. And Mike sent us a good question for you, and this is specifically for you, Doug. Does your bank only loan to companies in the Charlotte area, or can you entertain companies from anywhere in the country as long as they purchase a Charlotte company?
It's a great question. No doubt it is a lot easier for us if we have a company that's based in at least Greater Charlotte, as well as, you know, the guarantors and the sponsors are in Greater Charlotte as well. We have been known to look at transactions where either the guarantor or the company is in Charlotte. So there is an opportunity there. It makes it a little tougher from an underwriting perspective. And the main reason is just the accessibility of that. If the company were here, really good management in place, people that run the operations are located here, that's advantageous. Guarantors in another state or the owners in another state, we might be able to work through that a little bit better. If the guarantor is here, but the company is somewhere else, that gets a little tougher, because candidly, we as bankers want to be able to know we can get in a car and go kick tires and be able to see the entity and visit with the primary operators of the company. It's doable. It adds a little bit of a twist.
Mike, hopefully that has answered your question aptly. Got another question that is just coming in. Now, underwriting, this is from Mike as well. Is it in-house or subcontracted out to a third party? This is to you, Doug.
All in-house. Yeah, it's local, at least for our structure. very regionalized. So there's nothing centralized about it. We have an individual here in Charlotte, analysts that we work here in Charlotte. So no, it's all in-house.
Cool.
Hey, Doug, I'll piggyback on that just as a question for you. Just something we've seen on the SBA side. Do you guys handle that in-house too, or would you partner with somebody else typically on that?
Yeah, and we actually have a subsidiary organization which is an SBA provider. So it's all in-house.
Woohoo! That's great. That's actually nice, given some other experiences that we've had.
It keeps it all in the shop and keeps the communication lines open too between who referred it and the actual people underwriting. So it helps.
Well, we've seen one thing in this whole PPP with all of the banks, and that is you better have a good relationship with a good banker that you trust, and they better be backed up by a bank that can move. And you know, we've seen banks like First Bank run circles around other banks that will not be named, but they were like PT boats circling big battleships that couldn't move, and so it really, you guys really helped a lot of our companies, that's for sure, and you and others like you, Doug. So thank you.
Yeah, thank you. Very kind of you.
So for everybody that's still on the call, we will put this thing up on the BGW CPA YouTube channel, where we put up all of our other webinars. So they'll go up later on today. Anybody that's on here that wants more fun and frivolity around PPP will be live again tomorrow morning at 11 o'clock in the morning. It's always fun. You know, who knows what's going to be talked about next. So anyway, thank you to this all-star panel. And I don't say that lightly. Each one of these people on here, I've known for a long time, and I've seen them in battle. I would want them in my foxhole at any time I was doing a negotiation, and I've been involved in a number, and having the right people at the right time is really critical. You know, each one of these guys has said that, and you know, Brandy has seen it especially, where even just doing letters of intent and those kind of things, man, you can get in some real trouble by not having the right legal counsel by your side early on. Right, Brandy?
Absolutely. And Gary, I would add to that something I neglected to say earlier is with all of these advisors, particularly CPA, your banker and legal counsel, make sure you have if you're going into a transaction like this, that you get an M&A person, someone who's qualified and knowledgeable and has a lot of experience in M&A. You can get all of these advisors that are more generalist, and that's going to cause a lot of issues in the deal. So thank you, Gary.
Yeah, great point. Anybody?
Gary, I would just add one thing to that. You know, a lot of people come to us and say, oh, well, I don't want to get the attorney involved until this point, or I don't want to get the CPA involved, or I don't want to, and oh, your fee, all you guys, it's about the fees and getting the numbers running. And my whole comment is the expertise and the value you get from bringing your advisors in early so far outweighs the fees you're going to pay to any of us. And our goal is their goal, which is we want you to get the best structure based on your tax situation and based on your ownership position that the market will bear. End of discussion. All of us will put our clients' interests ahead of ours so they can get the right structure. So I say this lightly, but as an owner, you have to sort of be trusting to bring in enough outside advisors, show some humility, let us do our job. We stay in our lanes. We don't tell you how to run your business, but we will tell you how to run your process. We will tell you how to work on your taxes. We will tell you how to handle legal issues, but give us a chance to do the job for you so you can be successful and exit on your own terms.
Any, so this is a little bonus question that I'm going to ask the panel, but people love stories. And the last year when we did this live, I remember hearing some horror stories about what happens if you don't do that. So think about that, panel. Any stories that you would, kind of war stories that would be quick and brief and concise that you would be willing to share for if somebody did not bring you in early enough, Brandy or Adam in particular, or Doug or Adam Petricoff too. The mic's open.
I got one that Brandy and I worked on together. So one of the things that we do with our clients is we always ask them every time we talk to them throughout the process, what's changed? Are there any surprises? Anything I need to know about? And I probably asked that question to the seller 40, 50 times. And we're literally maybe a couple days before close. The client goes to Brandy's office, makes sure I'm not there, closes the door and says, okay, Adam's asked me about any surprises. I need to tell you about something. And literally we're a couple of days away from closing. And, once you get over the shock of it, it was a legitimate issue that had to be dealt with. So again, we had Brandy on board. She dealt with it in a professional and ethical manner. We took care of it, but it could have blown the deal. Very easily could have blown the deal. So you got to trust your team and your advisors. We're not just going to go share information, but we can make sure we avoid things if you share information. And Brandy, if you want to share anything on that story, if I missed something, please feel free.
No, you didn't miss anything, but it was great to be able to work with you and get that resolved, because we did have to involve you to, even though you weren't involved in the initial conversation, to help us get through the deal. So you were great. I will tell you a very quick and easy horror story. We had one of my largest clients who I did a family transaction for them to transfer wealth sort of to the next generations. Some people don't understand what an M&A lawyer is. And so he had been working with an estate attorney, his estate attorney, unbeknowingly to me, on a letter of intent. The estate attorney retired, and so he texts me and says, hey, do you know of a good M&A attorney? And I said, well, you happen to be texting one. And so long story short, he's like, I've got this letter of intent. Can you take a look at it? It's been through about 5 versions. Sure. He sends it over. Basically, it mentions an investment banking contract. And I asked to see that because I said, I don't want to step on any toes. I want to make sure I know what your obligations are. For a $50 million deal, he was obligated to pay 10% commission to the investment banker. And the deal itself was all kinds of, Adam Boatsman mentioned earlier about getting as much cash up front as possible, particularly pre-COVID. Is great, but it's a little different, even in great as well. And so he had more than half of it in earnouts over the next five years. It was a disaster. And so thankfully he was not happy to hear the results of our review, but we told him, and he was able to back out of it and negotiate out of it, but it wasn't easy. And so now he's with a completely different investment banker and another deal's going forward. So, but he didn't ask me to read the letter of intent. He didn't ask me to read the investment banking agreement. And so it's cost him more on the back end to get out of those.
Yeah, I think my worst one, Gary. I think from my experience, we have different types of CEOs as our clients, and some people that are do-it-yourselfers are just do-it-yourselfers. I mean, they're not people that, and I love them to death, but oftentimes it's the companies that the CEO has an engineering background. It just seems to be a common theme. They value smart advice. The problem is they just don't ask for it. So, because they're pretty smart people. So the worst one that we've had experience with is actually in 2012, when we were in the process of merging ourselves with another company, and that my client sold to one of our merger partner clients. And, you know, our transaction was done, so it was all one firm. So 6 months after we closed our transaction, so this was 2013-ish timeframe, my client came to me and said, hey, you know, I probably should have told you this and gotten you involved sooner, but I sold this part of the company. And it was about a $4 million value. I said, okay, well, yeah, you should have, but, you know, let's talk about the transaction. Who'd you sell to? Told me the name of the company. I said, oh, huh, that's interesting. They're a client. I didn't know them, but they were a client of the firm. They owed us money. They had stiff PNC and were in forbearance with PNC. We were about to fire them as a client. So just needs to say that client never got paid, and ended up filing a lawsuit that they never collected on. So, you know, I mean, that wasn't even involved with transaction structure, you know, or anything. It just simply, you know, in the business that we're in, Brandy's in, Doug's in, Adam's in, you know, Gary, you know, you're in. I mean, you end up meeting a lot of different people. So, you know, you end up, you know, having the opportunity to evaluate character or not. And I'm not going to necessarily talk bad about anybody, but, you know, my silence also says a lot versus, hey, that's a deal that I would do all day long. That guy or gal is awesome. So it just, you know, that one broke my heart because, you know, we ended up, you know, we represented both sides of the transaction, but didn't know you know, the other end of the transaction, you know, the one that was stiffest, and we were about to fire, we weren't told that they were acquiring either. So it just, the whole thing blew up. Both are out of that primary business, you know, today. And it just, you know, it's a shame. I mean, it's a leading indicator that they weren't people that generally speaking would seek out advice anyway, even when offered proactively. And the transaction just happened to be one of them. And the answer was, you know, the guy had a $4 million asset that he never got paid for, that he sold and gave up all rights to. So that's my worst story ever in this arena.
Those are some great stories. Doug, do you have one to add?
Top that.
Oh yeah, I can top it. There was a transaction, or a mutual client, I should say, of mine and Brandy's that involved some sub debt, and that sub debt had warrants in it, which, you know, just from a pure edification perspective, warrants essentially are an option that can be embedded in sub debt that at a certain time could trigger, and the debt holder could actually take some equity, take ownership of the company as a result. And Brandy, from what I remember, I think you got handed that deal last minute, like, I don't know, 10 minutes before closing to look at it, and you know, saw the warrants in there, and then obviously rightfully fought to have them removed or renegotiated. But classic point of, you know, a deal that had gotten pretty complex, and apparently prior to Brandy did not have the right representation to be able to combat it. But fortunately for their sake, they got in touch with Brandy, but otherwise that could have been a real mess.
You know, one thing that I remember from last year that I don't remember if we hit as hard this year as last year, but something that is worth considering: the longer you have to plan, 3 to 5 years in particular as an optimal amount of time, the better likelihood you have of having this thing be clean and go in an advantageous way for you from a tax standpoint and just from money in your pocket standpoint. You know, there's not a lot that any of these guys, as good as they all are, can do if it's a last minute fire sale. You're going to get hurt. So, you know, prior planning prevents subpar performance. So, anything else from this panel before we call it a day?
No, thank you. Just enjoyed it.
Thank you, everyone, for your time, and thank you, Gary, for moderating.
For sure.
My pleasure, y'all. You guys have a great day. Labor Day's coming up here. Enjoy your time with your family and loved ones when you can, and if you can. And we will put this up on the BGW CPA YouTube channel later on this afternoon. So thank you to everybody that was on this call. We are adjourned.
Thanks, Gary.